Tired of the stock market playing mind games with you? You buying a stock thinking it's rock bottom, only to see it dip even lower? Or selling at what it seems like a peak, only to watch in horror as it skyrockets? If you've been there, this video is for you. Hi, I'm Kelvin, and today we will explore 3 simple, effective frameworks for entering and exiting the market so you can make informed decisions and avoid those regretful moments. Stick around until the end, because the final framework is a closely guarded secret that you won't find anywhere else. The first framework is trend analysis plus support and resistance line. Trend analysis is a technique used in technical analysis that attempts to predict future stock price movements based on historical price data. There are 3 types of trends: uptrend, consolidation, and downtrend. Uptrend is like an uphill climb, prices consistently making higher highs and higher lows, suggesting investors' optimism. As for consolidation, it's a flat section of the right. Prices bounce within a specific range, suggesting indecision among investors with no clear direction for the future. And finally, downtrend is like a downhill descent. Prices consistently making lower highs and lower lows, suggesting investors' pessimism. By understanding these trends and the psychology behind them, we can gain valuable insights into how the market might behave in the future. The key is to trade alongside the trend and not against it. Now, let's add support and resistance line to the equation. Stock prices fight a constant battle between buyers and sellers in an epic tug of war. Support line is a price level where buyers gather their forces, increasing demand. They start the buying frenzy and prevent the price from falling further. Think of it as a floor where the prices bounces off. Resistance line is a price level where sellers stand strong, increasing supply. They start the selling and prevent the price from rising further. Think of it as a ceiling where the price struggles to break through. To draw these lines, simply look for areas where price has bounced off multiple times. Connect the low points for support and high points for resistance, like connecting the dots. The more time the price touches this line without breaking through, the stronger the line is. So, when do you enter or exit a trade? It might be tempting to pull the trigger right when the price touches the line. But hold on, always wait for confirmation. Just because the price touches the line doesn't mean it will bounce off. Sometimes the buyer or seller sentiment could be so strong, the price just breaks through the line. Hence, ensure the price bounces off the line first. Only then can you enter your trade. Alright, time to test your skills. We are now looking at the stock of Lululemon, ticker LULU. Can you identify the trends, potential support and resistance line, and areas to trade in the next 5 seconds? Pause the video if you need more time. Now, let's do an in-depth analysis together. At the start of the graph, notice how the price is making higher highs and higher lows. This indicates an uptrend. We can draw a trend line connecting these lows. See this specific area where the price touches the support line? It doesn't break through, but instead bounces back up. This is our confirmation for a potential uptrend continuation, hence a good entry point to buy. Now, in this area, we see the price isn't making consistent higher lows anymore, even though there are higher highs. This suggests the uptrend might be losing momentum. So we draw a resistance line at the peak, where price bounces back down. Look at how the price once again tests the resistance line and get rejected. This is our confirmation for a potential selling point to take profit. Same goes for here and here. Now let's add a support line to the consolidation phase. As you can see, here and here are potential buying points to pick up the stock as it bounces off the support line with confirmation. But what about here? Well, it might be on the support line. There's a long red candle after the touch, indicating a strong selling pressure. Hence, it might be wise to avoid entering a trade. As you see, the price soon breaks below the support line, confirming a downtrend. Here you can see lower highs and lower lows. So let's draw a resistance line connecting these highs. Here the downtrend seems to be on a pause. Notice how the price doesn't create a lower high or lower low, but instead reverses sharply and breaks above the resistance line. A crucial point to take note: when a support or resistance line is broken, it switches roles. Here, the broken resistance line now acts as a new support line. Here the price bounces off the new support, potentially signaling a return to the uptrend, and also a good re-entry point to buy the stock. As you can see, the stock then continues to rally upwards. So far, we have learned how to identify trends and potential entry and exit points using support and resistance lines. But sometimes they can't tell the whole story. How do you know if the stock is truly at its bottom or at its highest peaks? Well, that's where the second framework comes into play. Relative Strength Index, in short RSI. RSI is a momentum oscillator indicator that measures the speed and change in the price movements. Here's a simple breakdown. RSI goes from 0 to 100. If it's below 30, the stock is considered oversold, meaning it might fall quickly and could be due for a rebound. If it's above 70, the stock is considered overbought, indicating it might risen rapidly and could be due for correction. If it's between 30 and 70, the stock is in the neutral zone, neither too overbought or oversold. Similar to the first framework, confirmation is still key with RSI. Only sell the stock when RSI dips back below 70 or buy when it rises back above 30. Alright, let's put our RSI framework to the test with a real-world example using Tesla. Notice this point where RSI dipped below 30, buying at this point will come with a price tag of $150. However, if you waited for RSI to climb back to 30, that's a $113 entry point, a 25% discount. The same logic applies to selling. Look at these 2 points where RSI dipped below 70. Selling then will have given you an extra 9 and 28% profit respectively compared to selling when RSI rises to 70. Mind blowing, right? And that's the magic of confirmation signal. They double check your hunches. Now, let's see how powerful RSI can be when combined with our first framework of trend lines and support and resistance. We have a clear uptrend for Tesla, higher highs and higher lows. So let's draw the support line connecting the lows. Look at these areas where the price is bouncing off the support and RSI is bouncing back up from oversold territory of 30. This is textbook example of buying opportunities confirmed by both RSI and the trend. But wait, what about this point? The price does touch the support line, but has a long red candle. It indicates a strong selling pressure. On top of that, the RSI is still hovering around 40, not quite the 30 RSI we are looking for. Hence, this point might be a false bottom and the stock might not be ready for a rebound just yet. And as you see, the price drops sharply the next day. The key takeaway? Don't blindly trade just because the price touches a support resistance line. Always wait for confirmation when implementing any strategy. This can help you avoid false signal and make informed decisions. But even with 2 powerful tools in your arsenal, there's still one crucial tool that could be a total game changer for your investment journey. As legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." He understood the power of emotions in driving market movements. Fear can trigger panic selling, leading to prime buying opportunities. Conversely, excessive greed can inflate prices, creating potential pitfalls. So, how can we harness the power of fear itself to predict market movements? Introducing the final framework, the VIX, also known as a volatility index. Think of VIX as a fear gauge of the stock market, measuring the level of investors' anxiety. Let's take a look at these 2 charts. The top chart shows the VIX, and the bottom shows the Vanguard S&P 500 ETF, a broad market fund representing 500 large US companies. Notice a fascinating pattern. The VIX and the market move in opposite directions. When the VIX rises, signifying investors' fear, the market tends to fall. Conversely, a falling VIX suggests investors' greed and often coincide with a rising market. This inverse correlation between the VIX and the market will be the key to unlocking profitable trading positions. Now, let's mark a support zone on the VIX chart. This area suggests that the market is experiencing peak greed, with prices potentially inflated. This could be a good time to consider selling some of your holdings. On the other hand, the resistance zone on the VIX chart highlights areas where the market might be experiencing peak anxiety, and prices could be undervalued. This could be a good time to consider picking up some stocks. Remember, there's no guaranteed profit in the stock market, but understanding the VIX can definitely give you an edge. So, there you have it, the 3 effective frameworks to help you make informed decisions and navigate the ups and downs with greater confidence. The trend analysis and support resistance framework help you identify trends, entry, and exit points like a pro. RSI provides you a valuable gauge for overbought and oversold conditions, helping you avoid false signal. And finally, the VIX, the power of fear itself, letting you anticipate potential market shifts based on investors' anxiety. Remember, knowledge is power, and this video is just the first step. So let me know in the comments which framework resonated most with you and what other financial topics you would like to see. Don't forget to smash the like button and subscribe for more insightful content. Thanks for watching and see you in the next video.